For over 70 years, Horan has created plans to control healthcare costs, protect your wealth, and ensure your life. But the end game for all that we do at Horan is more than a set of plans. We believe good health and true wealth create a better quality of life for our clients and their families. And so as part of that mission, today we're going to spend about an hour or so, 45 minutes to an hour, talking about the wealth piece. And so if you are an upcoming retiree or a current retiree, we're going to go through, the purpose of today's presentation is to figure out what works best from you and kind of the inside scoop and secrets that you need to know about the industry, the financial industry, and things you need to be aware of to make sure that you're getting the best advice possible and that you're working with someone that you can trust. And so once again, my name is Michael Hermes. I'm a vice president at Horan. I'm one of our wealth advisors here. I'm a chartered financial analyst, certified financial planner, and national social security advisor. And so we're just going to jump right into it. At Horan, all of our advisors are fiduciaries. And so essentially what that means is, as a fiduciary, anytime you are getting a recommendation, it has to be in your best interest. And so currently in the financial world, there's two ways for the most part that a firm can operate. One is as a broker-dealer, and the other is as a registered investment advisor, an RIA. So Horan, we are both a hybrid. We are a broker-dealer and a registered investment advisor. The vast majority of our clientele falls under our registered investment advisor umbrella. And so in an RIA structure, which we'll talk about a little bit later, we have to act as fiduciaries and make sure everything that we're doing is in your best interest. And so it's kind of like going shopping for a new suit or dress. If I was acting as a broker-dealer for our relationship, I just have to make sure that suit or dress fits you. But under RIA, Registered Investment Advisor umbrella, and as a fiduciary, I also have to make sure you look good in that suit or dress. So taking those extra steps to make sure that everything is on the up and up and in your best interest. And so when approaching retirement, or if you're currently in retirement, I'm a Dave Ramsey fan, and so one of the things that he likes to say is personal finance is 80% behavior and only 20% head knowledge. And so throughout your retirement planning and in retirement, it's not necessarily what you know, but are you doing good, healthy habits for your finances to make sure that your money is going to last you throughout your retirement? And so it's not, which tax strategy do you have to utilize? Should I be doing Roth IRA conversions in retirement, or did I run a discounted cash flow on a specific stock and make sure that I'm picking the best stock out there? It's, am I following good, healthy habits that have held tried and true throughout the many previous years, and that you're going to have some sort of confidence in the future because of those habits. And so a couple things, the things that we're going to talk about today to really wrap everything together is choosing an advisor. And so how to make sure that you're working with someone who's reputable in the industry. It's kind of like real estate. So anyone can go out for the most part and get a license to sell investment products. But you want to make sure that you're working with someone who does take care and diligence when it comes to managing your investments. If you're a more do-it-yourselfer, what you need to know when it comes to your investment management and how firms charge fees, those sorts of things. You hear a lot in the industry, I'm sure, about annuities. Typically, when I meet with some of my retiree clients, someone has talked to them previously about an annuity. And so things you need to be aware of and cautious about when buying an annuity. If you're eligible for Social Security, the best strategies that you can utilize to take those benefits, long-term care insurance, which becomes pretty prevalent at retirement, and then lastly, your estate planning and making sure all of your assets get distributed exactly how you want them to upon your passing. So first, we're going to start off with choosing an advisor. And so anytime you're meeting with an advisor, you want to make sure that you ask them a few basic questions. And so the first one I kind of talked about earlier, so are you a fiduciary? And so if someone says no, more than likely you want to start running, but hopefully they'll come back and they'll say, yes, we are fiduciaries. because once again, as a fiduciary, all the recommendations that you get are in your best interest. The second one is, do you custody your own assets? And so by that, what we're alluding to is your firm doing the reporting and holding on to the investments that we buy inside of your investment account? And so, for example, at Horan, we're an independent advisor, and so we custody our assets with Fidelity. And so Fidelity is doing, or Charles Schwab. And so these companies are doing all the reporting and holding the actual assets at their firms. So Horan is not taking custody of those assets. And that is meant to be as a safekeeping to our clients. And so if a firm is, a smaller firm is doing they're custodying their own assets, you want to be cautious, because that can lead into potential problems such as, are they fudging the reporting numbers on your statements that you're getting monthly or quarterly? And that's kind of what we saw in the past with folks like Bernie Madoff. And so typically, unless you're at one of the very large institutions, a large bank or something along those lines, as a safekeeping to you, you want to make sure that if you're working with a smaller advisor, they are not actually custodying their own assets. Third question that you should be asking your advisor is, what is your advisory fee, right? And so we'll talk about this a little bit more in depth later, but with anytime you're investing with an advisor, there are two sets of fees. So the first fee is the fee that you are paying to be invested in the underlying funds and assets that they're putting you in. And the second one is the advisory fee. So what is the fee that you are paying every month to have someone continue to manage your money? And so figure out what their advisory fee is. And so with the advisory fee, industry standard is typically around 1% or so for that fee. The next question, what is the portfolio fund fee? So that's kind of what I alluded to before. So for example, an advisor might charge 1% per year to help manage your money, but then the funds that they're going to put you in charge a separate fee on the back end. And so ask what the portfolio's fund fees are. So what are the fees for actually being invested in those funds? And so typically a independent advisor should be using institutional share class funds or low cost F share class funds, which we'll talk about later. But for a typical portfolio cost, you should be looking anywhere from an additional 0.3 to 0.5% or so. And so now you have an idea of your all-in cost. So between the advisory fee and the fund fees, you're looking at anywhere from 1 to 1.5% or so. Another question that I don't usually get asked, but I think more folks should start asking is, as an advisor, do you have any advanced designations? And so once again, before I said anyone in this industry can get licensed to sell an investment vehicle, barring that you don't have a criminal background. And so just like a realtor license, but you want to make sure that you're not working with someone who just took a test real quick, passed the test, and now they're practicing as an advisor. And so one way you can make sure that you're working with someone a little bit more advanced with their knowledge is to ask if they have any advanced designations. And so some of the most common ones in the industry I've listed there. So chartered financial analyst. Essentially what a chartered financial analyst, it's kind of like having a doctorate in investment management. So it's very difficult to get this designation, and it's strictly focused on investment management and making sure people are picking the best and vetting the best investments possible for their clients. And so it typically takes the average person with a CFA designation roughly 4 years or so to get that designation. Another important designation is the Certified Financial Planner or Chartered Financial Consultant designations. Instead of focusing just on the investment piece, these people have pursued extra courses in insurance planning, estate planning, financial planning, taxes, and so they have a much more well-rounded background when it comes to financial advising. They're not focused on just the investment piece, although that does make up a portion of that curriculum. And then lastly is a chartered life underwriter. So these people have shown commitment to the life insurance industry by passing this exam. Typically takes around 6 to 9 months to achieve, but this is kind of like, in a sense, the chartered financial analyst for the life insurance industry. And so if you're ever looking at getting life insurance, long-term care insurance, disability insurance, make sure you're working with a chartered life underwriter. At Horan, all of our advisors are certified financial planners. Some of us are also chartered financial analysts, and for our life insurance division, we do have a few chartered life underwriters as well. But ask whoever you're working with, if they're thinking about working with, if they have any advanced designations. Another thing to consider is who you're working with. So ask your advisor, what type of clients do you typically work with? And so one of the things we're starting to see in the industry a little bit more is as advisors are developing a niche. So if you're a retiree, you want to work with someone who manages retiree wealth, and that's all they do all day, every day. That you might not want to work with an advisor who only specializes in small business owners or executives who are currently in the prime earning years of their career. You might want to work with someone who's strictly focused on retirement and current retirees. And so whoever you're working with, make sure that they do have a specialization in where you're currently at in your life phase and what's important to you. And then lastly, how long has your firm been in business and how much in assets do you manage? So making sure you're not working with a firm that might manage, call it $1 to $2 million. At Horan, we do advise on about $2 billion in assets. And so make sure the firm's been in the industry a long time and that they're reputable. And so if you're ever working with someone, I would encourage you to go onto that link right there, brokercheck.finra.org, and you can actually search for your advisor and see if they have any sort of disciplinary conduct on their record. So once again, it's just that extra safekeeping to make sure that whoever you're working with is best in class. So now that you have, all those questions that you can get ready to ask your advisor or someone that you're meeting with, that's essentially like your arsenal to make sure that you're working with someone good. We're going to talk about some different strategies that you can use to kind of wrap all your retirement picture together and things you need to be aware of in the industry. And so once you get to a retirement, one of the questions I get a lot is, Mike, I have all these different investment accounts. How much can I take out of my investment accounts without running out of money? And so the typical rule of thumb is, on average, you want to make about 4 to 5% per year conservatively on your investments, and you take about 4 to 5% per year conservatively from your investments. And so your account kind of stays the same over time. And so it's not meant to be rocket science. And so here, this is a graph provided by Fidelity that will show you, based off of how much you're taking from your investment accounts, what age you could expect those accounts to run out at. And so if you're taking out about a 6% distribution per year from your investments, that will typically last you until your early 80s before that account is depleted to zero, okay? If you're taking out about 5% per year, late 80s, and then 4% per year, for the most part, indefinitely. And so when planning for retirement, try to stick between that 4 to 5% rule. So if you have, call it $1 million between all your investment accounts, and you make, call it 5% per year, that's $50,000 a year that you can take from your investments. So just divide that number by 12, roughly call it $4,300 a month that you can take from your investments and income. Okay, so that's kind of the backwards way that you can get into identifying how much can you live off of from your investments. I guess, once again, when I meet with individuals, a lot of times they've just been investing in their retirement plan because that's what they've been told to do their whole life. And so they're in some sort of target date retirement fund, and they're not actually sure what the difference is between a bond and a stock, even though they've built up a healthy retirement, just because they've consistently put money into this account and it's been automatically getting invested for them. And so as a quick refresher, I just wanted to go around the different ways that you can actually invest in your portfolio. And so the first one is bonds. So when you're investing in bonds, essentially you are investing in a company's debt, okay? And so what that means is that the company, it's essentially a loan from a company. And so if I'm Amazon and I want to build a new warehouse, I'm gonna go out and say, hey, will anyone loan me $1 million? And so what I'll do in return is I will pay you 5% per year on that $1 million. And at the end of 10 years, I'll give you your $1 million back. Okay. So essentially, you're getting steady interest payments over time. And so with bonds, you can expect an average return on a bond to be anywhere from 2 to 4% per year with where interest rates are at today. Okay. But the reason that we like bonds is bonds are a safe investment as long as you are buying something that's typically rated A or better. So there are different companies out there that rate how safe a bond is. Make sure you're investing in hopefully A-rated bonds. Okay. And so that way, if a company were to ever default, bondholders are first in line to get any sort of payout from the company after they liquidate all their property, plant, and equipment, which is why they are considered much safer than stocks. But because they are safer, you're not going to get as high of a return. With bonds, which are ownership in a company's debt, with stocks, that is ownership in a company's profit. So you buy a stock, you are now a shareholder of the company. You are loaning a company, so company will issue shares to their corporation. They need to raise $2 million, so they'll go out to the open market and issue shares. And so you could buy a share in that company, and so you'll get ownership in that company. And so what they'll do with that money is they'll reinvest it in their business. Hopefully their profits grow. They take that money, they reinvest it into their business again. Hopefully it grows even larger, and so on and so forth. And so as the company grows bigger and bigger and bigger, you still have that same ownership in the company, and so your share price becomes worth more and more. But stocks are much riskier than bonds, and the reason that is because if a company were to go bankrupt, stockholders are last in line to get any sort of payout. But because it is riskier, on average, stocks tend to generate a higher return than bonds, roughly 7 to 10% per year or so. To get invested in stocks or bonds, and the way you've probably been doing it inside of your retirement accounts is through things like exchange-traded funds and mutual funds, which we'll talk about as well. So typically, we don't recommend investing in any one particular company. Reason being is there's a lot of risk associated with that. So what happens if an executive comes out and announces that the company is going to go bankrupt or that they've been fudging their numbers, in the case of Enron, on their accounting sheets, and all of a sudden you wake up and that stock's worth 30% less. Well, we recommend buying diversified exchange-traded funds and mutual funds instead, so that if one company were to go bankrupt, you don't feel that as much inside of your investment portfolio. And so the two primary ways, once again, to get exposure to diversified investments are through exchange-traded funds and mutual funds. So essentially what an exchange-traded fund is it's a passive way of managing your money. And so by that, what I mean is it tracks an index. So in the financial world, there's a lot of different indices out there. The two most common ones that you're probably familiar with are the S&P 500 and the Dow Jones Industrial Average. So the S&P 500 are the 500 largest companies in the U.S. What an exchange-traded fund will do is buy those 500 companies the exact same way that they're allocated in the S&P 500. And so that if the S&P 500 is up 10%, you're up 10%. If it's down 10%, you're down 10%. So it's just mimicking that index. But it's a great way to get exposure to 500 different companies so that if something were to happen to one of them, you don't have to worry about it because you're extremely diversified. Because if it's passively managed, these funds typically do have much lower fees associated with them. Some ETFs don't charge a fee at all. But typically around 5 to 25 basis points or so 0.05 or 0.25% is what you can expect to be invested. The fee you'll pay on an exchange-traded fund. On the opposite end, if you're a fan of something more active, where managers are trying to pick and choose the stocks that they think are going to outperform those indices, such as you can think of like a Warren Buffett, for example. He's picking and choosing the stocks that he thinks is going to do the best. You can invest in a mutual fund, okay? And typically mutual funds have active managers trying to outperform those indices. The thing, because they're actively managed, is they tend to have much higher fees than what's in an exchange-traded fund, okay? So with the mutual fund, you can typically expect to pay anywhere from 0.8 to 1% per year to manage, for that fund company to manage that money, okay? The big thing to note, and we're gonna talk about this now, is be careful of your share classes when investing in mutual funds, okay? There's a lot of different share classes with a mutual fund. And so by that, there's an A share class, a B share class, C share class, F, R, I, et cetera, et cetera. So you want to pay attention into what share class you are investing your money. And so, for example, if you're going to invest in an A share class, the way that those work, and those are typically made for retail investors, such as yourself, and so the way those work is there's typically a front-end sales charge, also known as a load. So to get access to that fund, you put in your money, and there's a front-end fee. And depending on how much you put into that fund, that fee will range, okay? But typically a front-end load, you're looking at about 4 to 6% in upfront load fees, okay? So if you put in $100,000 into this fund, and all of a sudden it turns into $94,000 because they charge the 6% load, okay? And then on top of that, they're going to charge an ongoing management fee, okay? Typically that ongoing management fee could be something like 0.6% per year, okay? So you pay a load up front, and then there's an ongoing management fee to manage that money. That's an A share class. That is typically what is sold by broker dealers, are those A share classes. C share classes, instead of there being a front end load, there's typically no load, but instead of say a 0.6 or 0.8 ongoing management fee, the ongoing management fee is going to be much higher because they didn't charge you that load off top. And so instead you could expect to pay, call it 1.2%, 1.3% per year for that fund to manage your money. And so if you're looking at an A versus a C share class, generally, if you have a long time horizon, it would be more beneficial to pay that load up front with an A share class, because over time that lower management fee that's on that A share class will be more beneficial to you over time. With R share classes, that's what's typically offered inside of your retirement plans, like 401ks, 403bs. There's no load fee to get invested in these funds, and there's typically a much lower management fee than A or C share classes. And so if you are currently using a 401k with R share class fees in there, those ongoing fees are typically half of that of an A share class. So instead of say 0.6, 0.7% per year ongoing fund fees, you're looking at more like 0.3%, 0.4%. And so if you're ever working with an advisor and they're talking about rolling your money out of a 401k that offers R share classes to stick you in an A share class where there's a 5% load and a higher ongoing management fee, you want to be very cautious of that. And so lastly, there are also I share classes and F share classes. These are also known as institutional share classes. These funds are typically offered by, in the name, institutions to their investors. And so for you to go out and get access to an I share class by yourself, you typically need at least $1 million to get access to this fund. By working through an advisor such as Horan, you're able to get access to those I share classes with as little as $100,000. But the way the I share classes work is pretty much the same as the R share class. So there's no load fee to get into that I share class, and the ongoing management fee is typically half of that of an A share class. So very, very similar to that R share class. So here's kind of an example of what we just spoke about. This is the American Funds New World Fund. It invests in different stocks around the world, okay? And so there's the A share class, which if you invest $49,999 into that fund, you will pay a 5% load on that. There's an ongoing fee of about 1.03% on that fund every single year, and your advisor will make a commission of 4.25% on that money and 0.25% ongoing. Okay, so just understand what the commission is being paid out to the advisor. With a C share class, there's no load, but if you take your money out within 1 year, there is a 1% contingent deferred sales charge on that money. And then the ongoing fee, because there's no load up front, is much higher at 1.78%. Your advisor will make a 1% upfront commission and then 1% per year ongoing that you're invested in that fund. With an F3 share class or an institutional share class, there's no load. The ongoing management fee, as we can see, is much lower at 0.6%, and there's no commission paid out. There might be ongoing advisory fees charged by the RIA if they're actively managing your money, but there's no upfront load commissions that you have to worry about. Same with an R6 share class, so no load, ongoing management fee, once again, of 0.6, and there's no advisor commission. It's inside your retirement plan, okay? So try and make sure that you are working with F share class and R share classes when possible, okay? All right, so you're finally investing. You realize that you want to invest in diversified exchange-traded funds and mutual funds, and you're going throughout retirement. And as we just saw this past March, you can be diversified, but that doesn't necessarily mean your portfolio there's no risks associated with a portfolio. And so back in March when the coronavirus, in February when the coronavirus broke out, stocks were down 35%. So I was getting a lot of calls from clients saying, should I sell out of the market? What should I do with my money? I'm scared, there's something I need to do. And this kind of illustrates this chart right here, what you need to do in retirement when something like that happens. You know, coronavirus wasn't the first and it's not going to be the last. And so they're going to be typically every 8 years or so, there's a recession in the United States. And so this kind of illustrates what you want to do with your money. And so as long as you are in a good diversified strategy, you will want to stick to that strategy, okay? Don't get fancy and try and market time your portfolio. And so that, what I mean is try and guess and time and sell out of your investments and buy back in, et cetera, et cetera. So this chart shows $10,000 invested in the S&P 500 index from January 1, 1980 to December 31st, 2018, okay? And so call it 30, 40 years or so of investment returns. If you would have invested that $10,000 to stay invested the whole time, and remember this includes recessions such as the tech bubble in 2000, 08, 09 financial crisis, you still would have ended up with $659,000. That $10,000 would have turned into $659,000. In those 30 to 40 years, if you would have only missed the best 5 days of stock market returns because you were trying to market time, you would have cost yourself $232,000 of return. If you missed the 10 best days, you would have cost yourself $341,000. And if you missed the best 30 days of stock returns in those 30 to 40 years, you would have cost yourself $534,000. So hopefully this chart kind of speaks to itself. Don't try and market time your investment portfolio. I promise, or can't promise anything in this industry, but from my experience, what I've seen is it will not work, okay? People are inherently bad at trying to pick and time when things in the markets are going to work out. And so one of my favorite quotes by Peter Lynch, who used to manage the Magellan Fund, which has had a great track record of success. He said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. So don't market time with your portfolio, stick to your risk posture. And so that kind of leads me into the next point is set an appropriate investment mix for your age and risk level. So a typical retiree portfolio, in order to get that 4 to 5% return per year, you want to be invested roughly anywhere from 40 to 60% in stocks and 40 to 60% in bonds, okay? And the whole idea behind that is when stocks are doing good, you can peel away your money that you're taking out from distributions from those stocks. And if stocks ever crash, you have 40 to 60% of your money in safe, stable bonds paying 2 to 3% interest per year. And so you're going to start to fund those distributions out of the interest payments in the bond portion of your account. And what that does is that gives your stocks time to recover like they've always done in history. And so by you setting that appropriate mix ahead of time, you are getting ahead of any sort of crashes that might happen, okay? So set an appropriate investment mix for your age and risk level. Once again, typical retiree portfolio, anywhere from 40 to 60% in stocks and 40 to 60% in bonds. Here's some examples of those allocations. But when it comes to managing your investments at retirement, you want to make sure that you do a few things. And so the first one is to organize your accounts. A lot of times I'll meet with individuals who have a 403B and a 401K and an IRA and another IRA at this institution, and all of those accounts can be consolidated into one investment account. And what that does is it makes it much easier to manage that account, okay? And so also, if you have 4 different accounts, those are 4 different accounts that you have to make sure that you're updating your beneficiaries on. And so I met with a physician one time. He showed me his 403B statement, and he still had his ex-spouse from 2 wives ago as the beneficiary on his account. And I'm sure his current wife wouldn't appreciate that if he passed away. And so make sure that by having everything organized and consolidated into one account, if that's what's best for your situation, that those beneficiaries are also updated, okay? And so one of the things that also makes it easier to do is make sure that your overall allocation is close to that 60-40. So don't just view one account as 60% stocks, 40% bonds, and another account as 60% stocks, 40% bonds. You could have 100% stocks in one portfolio and 100% fixed income bonds in another portfolio, and so together that makes up your 60-40 portfolio. So look at everything in a whole, not just one portfolio at a time. Okay, so that's kind of the refresher and the things you need to know when it comes to your investment management. So just to recap, understand the share class of any mutual funds you're investing in. Exchange traded funds, you don't have to worry about that. Understand the commission that your advisor is going to get paid for putting you in any one particular fund. And then 4 to 5% per year withdrawal rate is a good conservative withdrawal rate on your investment portfolio, okay? And your overall retirement allocation should be anywhere 40 to 60% stocks, 40 to 60% in bonds, okay? So with that, that brings me to annuities, the good, the bad, and the ugly. So I meet with a lot of people, and they might have another advisor talking to them about why they need an annuity. And annuities are some of the most complex products that are difficult to understand, and there's a million different flavors of them, okay? So each insurance company might have 3 or 4 different annuity products that they sell. And so with all the insurance companies out there, those are thousands and thousands of annuity products that you could potentially invest in. So if you are thinking about buying an annuity, you want to make sure that it is what's in your best situation, okay? And so there's 3 different types of annuities. There's fixed annuities. So the way a fixed annuity works is I have $100,000. I'm going to give my $100,000 to an insurance company, and they're going to invest it in what's called their general account, and they're going to pay me, call it 2% per year for the rest of my life on that money. So it's just a fixed way of getting a fixed return. You're not subject to market risk inside of that account. A variable annuity, the way that works is you have $100,000, you're going to give it to an insurance company, and you can pick and choose which investments you want to invest in their different sub-accounts. So they might have access to, say, some American funds, mutual funds that you can invest in those sub-accounts, okay? But the whole premise behind these annuities is that one day you will annuitize them. And so what they'll do is they will give you a guaranteed payment for the rest of your life. So you are essentially creating your own pension out of your money, okay? And so, but with a variable annuity, you're investing that money, so it is subject to market exposure, and then one day you annuitize that, and you'll get a guaranteed, call it 5 to 6% per year on that money for the rest of your life, no matter what happens to that underlying account value. And then the last one is indexed annuities, and these are typically for people wanting downside protection. So I'll give an insurance company $100,000, and I'll buy the S&P 500 index. And so over the next 6 years per se, what the insurance company will do is they'll guarantee me that if the S&P 500 ever loses 20%, that I will be covered on that 20%. And so the insurance company will pick up that loss, so I don't have to worry about that loss. I still get my whole investment. But on the opposite end, you're giving up your upside return potential. So if stocks return over those 5 years, call it 80%, you're going to be capped at 60%. And so you're only going to be able to partake in the first 60% of returns. So you're giving up some upside for the potential of downside protection. With all annuities, you need to be cognizant of the fees that you're going to pay. Okay, so the whole purpose of an annuity, for the most part, is that the insurance company is going to send you some guaranteed income for the rest of your life, no matter what happens to the investment account. Okay, and the way that they're able to do that is because they're charging you fees. Okay, so they're taking fees off of your money, and then they're going to use that to pay you back if your account value ever drops to zero, and they're still sending you those insurance payments. Okay, so some of those fees you can expect to pay are administrative fees for managing the money, surrender charges. So, for example, when you invest in an annuity, you're typically locked in for a certain amount of time. So we'll call it 8 years in this example. And so the first year, if you ever want to pull your money out of that annuity contract, they are going to charge you a 7% surrender charge on your money. Year 2, it drops down to 6%. Year 3 stays at 6%. Year 4, 5%. Year 5, 4%, so on and so forth. Until year 8, it is 0. There's no more surrender charge. Okay, so you're going to get locked up inside of this annuity contract more than likely. So make sure you understand those surrender fees and that you won't need access to that money. If you do need access to the money, typically most companies do offer a 10% penalty-free withdrawal. So if you put in $100,000 and you need access to $10,000 because you forgot about some sort of upcoming expense, you can get access to that without any penalties. Mortality and expense fees, so that's the fee that you're paying in case the account ever drops to 0 and the insurance company still needs to send you a monthly payment. Mortality and expense fees are typically anywhere around 1.5% to 2% per year. And then if you're investing in a variable account, a variable annuity, there are also investment fees for being invested in the underlying sub-accounts, which will tack on another, call it 1% or so. So typically for an annuity, your all-in fee that you're looking at, assuming you're not buying all sorts of different riders, which are extra alternative things that you can add on to your annuity to offer different sorts of benefits. Just for a plain Jane vanilla variable annuity, you're typically looking at anywhere from 2.5% to 3.5% in fees on your money. And so naturally, those fees are going to deplete your account much faster over time. So there's a few cases where investing in an annuity makes sense. And so one is to cover lifetime necessary expenses. And so if you're getting ready to retire and you need, you write down all of your budget ahead of time, and so you know what fee or what expenses you need to pay for every single month. So for example, like your mortgage, your water, your utilities, et cetera, things not like your vacation fund, for example. So necessary expenses, it might make sense to take a portion of your money and buy an annuity with that portion so that you will always have a steady stream of income to guarantee that you can meet those needs. The second is for pension arbitrage strategies. So for example, if you have a pension through your employer that offers a lump sum benefit payout and also monthly distributions from that, there could be strategies where you take the lump sum portion, you use the lump sum, you pay off remaining debt, and then whatever remaining assets you have left after you take out that lump sum, you buy an annuity with that product to get that steady stream of income. Or vice versa, you take out that lump sum and then you just buy an annuity. There have been times that I've seen in the past where individuals have been able to get a higher guaranteed payment by taking the lump sum and buying an annuity with it than what they were offered from the pension itself. So kind of to recap once again, with annuities, the good thing is they're going to provide you with a guaranteed stream of income for the rest of your life. They allow for a beneficiary to inherit your money. So the way the industry used to work is it was use it or lose it. And so if you pass away and there's still money left in your account before you pass, or after you pass rather, there was no payment to the beneficiaries. These annuities have changed a lot. So now a typical annuity does provide a payout to a beneficiary and it helps reduce some of the risk in your portfolio because you're not subject to that market risk like you would be if you were invested in stocks. The bad about them is the fees. Once again, typically 2.5% to 3.5% is what you're looking at for your all-in fee, whereas if you would just take it to a regular investment advisor, the fees are going to be closer to 1 to 1.5% per year. And so because of those extra fees, your money's going to deplete quicker over time. And then the ugly with annuities is a lot of times they're sold to people who don't necessarily need them, and advisors make a big commission off of selling annuities. So you can expect to pay an advisor anywhere from a 5 to 6% commission payout on your money. So just be cautious that the advisor you're working with is telling you to buy this annuity for the right reasons. All right, so you have your pension that you're going to take from your work. You have your investment accounts that you know you're going to take 4 to 5% per year on, and so you have an idea of what kind of monthly income you can expect in retirement. And so the last piece of the puzzle for most people is the Social Security and what they need to do there. So individuals, a couple statistics according to Social Security Administration. So men turning 65 today, on average, will live to be about 84 years old. Women turning 65 today will live to be roughly 86, 87. If you are married and you're married at the age of 65, the chances that one person will survive to age 85 are more than 75%. Let this one sink in. 1 in 3 individuals 65 years old today will live past age 90, and 1 in 7 individuals today who are older than 65 will live past age 95. So people are living a lot longer than they used to. Okay? So when working with an advisor, make sure that they're planning on you living to be at least age 90 to 95. Personally, with my clients, I like to use age 95 because I would rather you not outlive your money, right? And so Social Security is a big part of that equation to make sure you don't outlive your money. And so typically, you hear a lot about from friends and family that Social Security is going broke and I'm not going to get anything out of Social Security. And as the way it stands today, that is not true. So the way it works today is that in the year 2035, you can expect to get roughly 80% or 79% of your benefit payment. So in the year 2035 with Social Security, the trust fund, the Social Security Trust Fund is depleted to 0, and so they can only pay out as much as they take in every year. So everyone will get roughly 79% of their benefit in the year 2035. That's without any sort of reform. There are plenty of ways to reform the system to make sure that everyone gets 100% of their benefit payment for their life. And so most people, so I wouldn't worry too much about the system going broke at this point. So just keep your eyes out on the news. There's currently a bill in Congress. It's called the Social Security 2100 Act. If that gets passed, everyone's going to get 100% of their benefit payment through the year 2100. The way that they're proposing to fix the system currently is to just increase the overall tax rate on Social Security and increase the overall amount that's subject to tax. And so if you're getting ready to retire and you're just planning on collecting and you're not working anymore, you don't really have to worry about that. So most people know this, but the earliest you can file for Social Security is age 62. You don't have to wait until your full retirement age, which is on the statement. If you were born before 1954, your full retirement age is 66. And then they kind of stagger it every single year after to 66 and 2 months, 66 and 4 months. And then if you were born after 1960 and later, your full retirement age is age 67. But point being is you don't have to wait until your full retirement age to get your benefit. You can start your benefit as early as age 62, but each year you take it early, it's going to be discounted roughly 7% per year, okay? And then on the opposite end, each year you delay taking your Social Security benefit, it's going to increase 8% per year until age 70. So I had a guy call me one time, he was age 72. He said, Mike, when should I start taking my Social Security benefit? And I told him you should have started taking it 2 years ago because there's no more delayed retirement credits after age 70. And so he called up Social Security, and the most they would lump someone back is 6 months worth of missed payments. And so he missed out on 1.5 years worth of Social Security checks because he waited too long. So my point being is never wait past age 70 to begin collecting your Social Security, okay? But there's some different strategies. We're going to skip one slide. So, you know, a lot of people say, you know, should I take it at 62? Should I take it at my full retirement age? Should I wait until 70? Here's a rough estimate, break even on that money. So, for example, if you waited until age 70 to start collecting versus taking it at 66, you're missing 4 years worth of checks by waiting, right? And so the break even on that chart is roughly age 82. So if you think you're going to live longer than 82, it would have made sense for you to wait until 70 to begin collecting, more than likely, okay? So once again, if your family has good health history and you think you're going to live a long time past 82, which if we refer back to that Social Security statistic page on life expectancies, most people will live to be longer than 82. By delaying your Social Security until age 70, that will be more beneficial for you in the long run. There's some ways and some strategies that you can maximize your benefit even if you never contributed into the Social Security system. You might be eligible for a higher payout. The most common one is the spousal benefit. So you can get the greater, when you apply for your Social Security benefit, you can get the greater of your retirement benefit or 50% of your spouse's benefit. And so if 50% of your spouse's benefit is higher than what you might be eligible to collect off of your own record, I would encourage you to look into that spousal benefit. The same goes if you're divorced as well. And so if you have been divorced for at least 10 years, you might be eligible for a higher benefit amount off of your ex-spouse's record, okay? So once again, married at least 10 years, you can get the greater of your benefit or 50% of your ex-spouse's benefit. If your spouse passes away, you might be eligible for a higher benefit off of their record as a survivor. So if your spouse passes away, you can collect the greater of your benefit or 100% of your deceased spouse's benefit. And this is also available to individuals who are married for at least 10 years. So if your ex-spouse passes away, you can also collect the greater of your retirement benefit or 100% of your deceased ex-spouse's benefit as well. If you begin collecting Social Security and you have dependent children under the age of 18, they are also eligible to collect 50% of your Social Security benefit amount through age 18, as long as they're enrolled in high school, or 75% of your benefit amount if you were to pass away. And then lastly, there's one strategy left called a restricted application, which is a little bit more of a complicated strategy. It's only eligible to individuals who were born on or before January 1st of 1954. Essentially, what a restricted application allows you to do is from age 66 until 70, collect a free spousal benefit, and then your personal retirement benefit will continue to grow 8% per year until age 70. So that by the time you turn age 70, you flip from taking your spousal benefit to your increased retirement benefit. And so if you were born on or before January 1st of 54, I would encourage you to look into this. The Social Security Administration, they're order takers. They're like a drive-through. You go in, you tell them what you want, and hopefully they'll give you what you ask for. They're not financial advisors, and they're not going to make sure you're utilizing a strategy that is best for your personal situation. So make sure you know what you want to do before you go in ahead of time. Social Security can make the difference of a couple $100,000 over the course of your lifetime. Okay, so don't take that decision lightly. So our recommendation for most individuals is to delay taking their Social Security as long as possible, or at least wait until their full retirement age. Once again, it's a guaranteed 8% increase on your money, whereas inside of your investment accounts, there is no guarantee inside of those. Your Social Security is perfect because it adjusts with inflation. Your investments don't necessarily keep up with inflation. And so lastly, your Social Security is taxed more favorably than your investment accounts. And so at least in Ohio, if you're going to take out money from your 401k or your IRA, you have to pay federal income tax and state income tax on that money. With Social Security, there's federal income tax, but only 85% of your benefit payment is subject to that federal income tax, and there's no state or local tax in Ohio on your Social Security benefit. And so by you delaying taking that benefit, that's more tax-free income coming into you after retirement. So there's Social Security's website. I would encourage everyone to go online after this presentation and create an account if you haven't yet, and pull your Social Security statement to get an idea of what benefits you might be eligible for. All right, so we have about 10 more minutes here, so a couple other things we're going to talk about. Last two topics here, long-term care and estate planning. And so 7 out of 10 people over the age of 65 will need some sort of long-term care support. So 70% of people will need some sort of long-term care support throughout their life. 63% of individuals, though, use their retirement savings to pay for this care because they weren't properly insured. And 100% of families are affected by long-term care events in some form, some way. And so most people I meet with, they still have old life insurance policies, but they don't have any long-term care insurance coverage. And so in a perfect world, you're 65 now, you're retired, you don't have any more debt, and no one depends on you, so your need for life insurance is at a minimum. And so most people at 65 need to focus on getting some sort of long-term care insurance instead. And really, the biggest reason that you would need long-term care insurance is so that your children, if you were to experience one of these long-term care events, remember you as you were as a parent and not a patient, because they're not going to feel that burden of long-term care. And so the cost of a private nursing home facility in Ohio today, Cincinnati, in 2019 is about $322 per day, or $117,000 per year. So the typical stay for a female is about 2 years or 3 years in a long-term care facility. Typical stay for a male is about 2 years. If you were to get Alzheimer's or dementia, the average stay is about 6 to 8 years. And so that's becoming more and more common as people begin living longer and longer. And so if we inflate that out by, call it 5% per year, and to 2040, when you'll actually need your long-term care insurance or have some sort of long-term care event, you're looking closer to $599 per day or $200,000 per year to fund any sort of long-term care event. Okay, so it's very expensive. It will diminish your portfolio over time if passing on an inheritance is important to you. Protecting your assets from a long-term care event should be taken up with utmost importance. And so there's a lot of different ways that you can get exposure to long-term care. Some annuities offer a long-term care rider. Some life insurance policies also have a long-term care rider in there as well. So double check if you have an annuity or a life insurance policy that they have some sort of long-term care protection with inside of those. A lot of people, when they think long-term care insurance, they think it's like their car insurance, where you're paying a premium every month, and if you don't use it, you lose that money. And that is correct. That is the way that traditional long-term care insurance works. And so our favorite way of funding a long-term care policy is through what's called asset-based hybrid life insurance. So it's both life insurance and long-term care insurance. And the reason that most people can't get access to an asset-based hybrid policy, though, is because typically you need, call it $50,000 to pay a lump sum benefit. But the nice thing about these policies is they're not use it or lose it. And so if you have $50,000, it will provide a death benefit of, call it $55,000. And so, but if you need it for long-term care insurance, it will provide a long-term care insurance benefit of, call it $110,000. And so it protects you both in the event of death and a long-term care event from happening. Once again, the reason that most people can't get access to this is they're typically single premium, or the premiums that you do have to pay are very high cost, and your money's not locked up. So if you ever need access to that money you put into the policy, you can take that money back out from the policy. That just reduces your death benefit and your long-term care benefit, okay? But most people, we say, if you can, try and stay away from the traditional type of long-term care insurance. Insurance companies can raise those premiums on you any single year. I've seen those premiums go up 50% a year before in the past. But if you're not able to get access to a life insurance policy or a hybrid policy with some sort of long-term care rider, looking at some sort of traditional long-term care policy might be in your best interest. And so we do have a life insurance department at Horan who would be happy to talk through your options with you in more detail if that was something you were interested in. But we do recommend individuals upon retirement at least look at getting some sort of long-term care insurance. All right, lastly here, estate planning. So typically when I meet with individuals, I ask them, when was the last time you updated your will and your powers of attorney? And they said, oh, when my kids were just born, which is over 20 or 30 years ago. And so most people, I encourage you to at least dust off your old documents and make sure they're still relevant today. Everyone needs, at the minimum, 4 basic documents, okay? A will, so what do you want to have happen to your assets if you were to pass away? A living will, which talks about, do you want to maintain yourself on life support should something happen to you? A healthcare power of attorney, so if you were in a coma, who can make medical decisions on your behalf? And then lastly, a durable financial power of attorney. So if you were in a coma, who can go into your investment accounts and take out money and continue using that to pay for your bills? And so you need a legal document that specifies those individuals who can get access to the money. Just because you have your spouse as the beneficiary on the account does not mean that they can get access to that money if something were to happen to you, okay? And then lastly, most people, we do recommend that they get a trust. And essentially what a trust does is you can put rules around how you want your money distributed upon your passing. And so if you have very young or very irresponsible children or children who are in a rocky relationship and you have $1 million and you name them as beneficiary on that account, that money goes directly to them. And so if they were to get divorced, ex-spouses have claims to half of that money. And in addition, if they're not responsible with money, they just inherited $1 million and they can spend it however they choose to. And so what a trust does is it makes sure there's rules and restrictions around how your money can get distributed. And so with a trust, the money, you would name your investment account, you would name the trust as the beneficiary on your investment accounts. And so the money flows through to the trust. You name a trustee who's responsible for distributing that trust according to your rules that you put inside of the trust. And so it's much more protected from creditors, from ex-spouses, and from irresponsible children. And so most people, I would encourage you to get a trust set up. For those 4 basic documents before, so the will, the living will, healthcare power of attorney, and durable financial power of attorney, for most married couples, you can get those documents done for about $800 or so, $800 to $1,000 through an estate planning attorney. To get a trust, depending on how complicated you make it, you're typically looking at another $1,500 or so on top of that. And lastly, double check your investment accounts and make sure your beneficiaries are appropriately updated, okay? But make sure if you're to get these documents done that you are working with an estate planning attorney, okay? Don't work with a criminal attorney who's a defense attorney and they just on the side happen to do estate planning. Work with a firm that is dedicated to doing estate planning. Okay, and so with that, I know we covered a lot of topics today. Hopefully you have a little bit better of idea of what to expect in retirement and the things you need to be aware of in retirement. If you have any questions, we don't charge for answering questions, and so, or getting together. Feel free to give me a call or send me an email. My number's on there. But we really appreciate everyone's time today. And hopefully we'll be able to, we host a lot of these seminars in the future. And so keep your eyes out on your email for things like Social Security and Medicare seminars as well, because we do cover more topics than just what was covered today. But once again, thank you for your time. I appreciate it. And if you have any questions, just know that you have a resource available to you.